Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically what we are doing, we are covering the non-banking finance companies. Okay, this is the new topic we are going to discuss about. Alright, these are the topics basically we have scheduled for the discussion in this particular series of the NBFC. Like we will start with the introduction, we will take the introduction. Then credit intermediation, asset financing, house financing or housing financing you can say, microfinance, investment and the wealth management, infrastructure finance, conclusion. Okay, these are the topics basically we have scheduled for the discussion under the non-banking finance companies heading. Also it is known as NBFC. Okay, so before starting the formal introduction, it is the best way that we should discuss it here so that we could get an idea like what do you mean by the non-banking finance companies, how they work and other things. Okay, so basically if we first talk about the two areas which is known as the banking, second is the finance. Okay, like there are two ways, banking and the finance. Got it? So now I'm asking you the question like what is the difference between these two things? Like how the banks operate and why the finance is separated from the bank. These are two questions. So basically, if we try to decode it, then what we will find? We will find that bank is an organization which accept deposits, okay, make investments, or you can say grant loans. Okay, this is the first thing. Accept deposits, make investments, or grant loans. Okay, whereas if we talk about the finance, then basically provide credit or loan for different type of sectors. Okay, so this is the formal difference between the banking or the finance institution. Like if we talk about the banking, they accept deposits, make investments or grant loans, whereas the finance basically they provide credit or loan for the different type of sectors. Okay, like you could say, if we talk about two areas, okay, like this one and this one. So here, this is called as the financial corporation. Okay. This is called as a banking. Alright. So here are two persons. This one. This one. Okay. So basically if we talk about the availing of services, if we talk about it, then basically the banking institution could accept deposits, grant loans, but because we are talking about from the customer point of view, so we will talk about the taking loans concept. Okay, so because this person who is here, he is not only capable of opening the saving accounts but also capable to take the loans and you can say credit facilities from the banking. Whereas when we talk about this person, then he is only applicable to get credit or loan from the organization. All right. So this is just a general way picture, like how the financial corporations are, you can say, different from the banks, because there is only one difference, and which is accepting of deposits. All right. So remember, the financial corporations are generally not allowed to accept the deposits. Okay. So this is just an picture of banking versus finance. All right. And by the name of it, you could understand that it is named as NFFC, which means non-banking financial corporation. All right. However, it is a financial corporation, means that it is allowed to make investments or grant loans, but it is non-banking also. So that's why not allowed to accept deposits. All right. So keep this introduction in your mind before we start with the formal introduction. Okay. All this one. Let's move ahead. NBFCs provide various financial services such as loans, advances, investment, and asset financing, similar to the banks. Okay, like all these are the credit facilities. Okay, however, they cannot accept demand deposits like bank, which I had already told you. Like their house, the banks are allowed to take the deposits or accept deposits. The NBFCs are generally not. Okay, NBFCs are regulated by the Reserve Bank of India under the RBI Act 1934. They must comply with the regulatory requirements related to the capital adequacy, governance, and the risk management. Okay, so remember in the previous lectures also, I had told you one thing. If we talk about developmental financial institution, okay, thereafter, when we talk about the financial institution, okay, then we talk about the banking institutions. Okay, so when we talk about all of them, developmental, financial, and the banking. All right. So remember, developmental financial institution and the financial institutions are, you can say, moreover the same. The only difference is these are in general, not specific. These are specific, not in general. Okay. So keep this thing in your mind. Whereas banking, we know that it is allowed for taking deposits and granting loans. All of them, is basically comes under the purview of Reserve Bank of India. All right, whether it's a developmental financial institution, the financial institution, or the banking, they all comes under the RBI by virtue of which act? By virtue of Reserve Bank of India Act 1934. All right. So because right now we are talking about the financial institutions, so that's why we are also including it. All right. So NBFCs are also regulated by the Reserve Bank of India under the RBI Act 1934. They must comply with the regulatory requirements like the minimum capital adequacy, like the governance, like the risk management in the lending out activities. Okay, as per the norms of the Reserve Bank of India. All right. NBFCs plays a crucial role in extending credit to the sectors of economy that may not have easy access to the traditional banking services, thereby promoting financial inclusion. Okay, like basically we talk about this one. All right. Right now I'm going to tell you of one general fact. Like suppose this is a bank. Okay. And this is the financial institution. Okay. Now we have the one person, this one. Okay. This person is in the need of rupees 20 lakhs. Okay. How much money is required? 20 lakhs he required. All right. So basically, if he goes to the bank, okay, suppose the bank name is XYZ and this financial institution is named ABC. All right. So this person is in the need of 20 lakhs. It means that he requires the worth 20 lakhs credit. Okay. So if he goes to the bank, the must condition is must having bank account in that bank. Okay, this is the first condition. All right, like if this particular person is going to have a loan from the bank in the XYZ, so he must have any account in the XYZ. This is the foremost condition in the most of the times. Until or unless he is not having any account with the XYZ, he will not grant it with the loan that easily. First condition. But if he goes to the financial institution, so he is not required to open any kind of bank account, or you can say any type of account. Why? Because these are not allowed for deposits. Okay, so that's why they do not require any type of account. However, they will open a loan account for that person, but he is not required to having the permanent account in the ABC. All right, so that's why this type of fellow persons who are not able to maintain a permanent bank account, and that's why they are generally excluded from the banking sphere. All right, so that's why the financial institution, or you can say the NBFCs, are you can say the body who make sure that these people must be financially included. All right, so this is the meaning of this particular para. Unlike banks, NBFCs cannot issue checks drawn on themselves. They are not part of the payment and the settlement system. which means that they cannot operate saving accounts for the public. However, they can raise funds from the public directly or indirectly. Alright, like you can say, suppose if we talk about the banks. For example, we're talking about the XYZ and this is a bank. Alright, so we know that bank is generally lend out the amount to the general public, or you can say to make the investment. They generally do this kind of activities. Now the question is, from where the fund come? The fund is basically comes from capital plus deposits. Okay, so capital plus deposits make the you can say liquidity with banks to grant out the loan and other kind of activities. All right, but when we talk about the but when we talk about the ABC, which is a financial institution, the ABC. So we know that ABC are generally not allowed to accept a deposit, which means that their disadvantage is finished, not applicable. So what left? Only the capital which was invested is left. All right, but we know that capital is not sufficient for meeting the requirements and meeting the demands. Okay, so that's why what they will do, they will raise the shares or raise the fund through the shares. Okay, that is the main reason. All right, and this sharing could only be issued whether directly, okay, or you can say indirectly. All right, so keep this thing in your mind. Now after, you can say after the introduction, now we have the credit intermediation. So what do you mean by this? Let's understand. Overview. Credit intermediation refers to the process of channeling funds from savers to the borrowers. This is a fundamental economic function traditionally performed by banks, but NBFCs have carved out a significant role for themselves in this area. Like you could say, suppose there are two persons, this one, this one. Okay, this is the borrower, this is the saver. Okay, so going by this definition, what do you think? The saver will have excess amount. Okay, the borrower will have need of amount. Two conditions are there. All right, so basically if we talk about the bank, suppose this is the general bank. So what will happen? The saver will submit the excess amount in the bank and the bank will grant the loan to the borrower. All right, loan, deposits. Okay, two conditions are there. All right, saver, borrower. Saver having the excess amount will submit it or deposited the money with the bank. Borrower is of the need of the amount, so he will take a loan from the bank. Okay, so here you can say this is the credit intermediation. Why? Because credit is flowing from one channel to another channel. All right. But when we talk about the case of the NBFC, saver, borrower, okay, NBFC. So now the question is how the saver will deposit the amount with the NBFC and how the NBFC will lend out it to the borrower. Because in the previous case we had seen that it is a bank which could accept the deposits. So how the NBFC will do it? So by simply raising up of the funds from public directly or indirectly. All right. So that's how the system works. And this is also known as credit intermediation. All right. Now let's move forward. Understanding undeserved markets. NBFCs have a deep understanding of their customer base, which often includes those who might not have formal financial histories or consistent cash flows that are typically required by the traditional banks for the credit assessment. Okay, by in their name, what you are finding? Non-banking financial companies, right? This is the name. So in their name, what we could see? We could see the companies. Okay, companies indicates that this is a business. Business indicates that there will be a profit motive, right? This will be the picture. Non-banking financial companies, business equal to profit motive. All right. And for the, you can say the growth of the business and you can say to enlarge the profit, basically market understanding is required. Okay. And NBFC is generally, you can say, deals with the undeserved market. Okay. Why? Because the people of this market generally do not having the bank accounts with the bank, generally do not having the formal financial histories or the consistent cash flows, okay, which are typically required at the traditional banks for credit assessment. Like whenever you have gone for the loan process, or you can say anyone of your family has gone to the loan process, they generally ask like from which bank you had withdrawn a loan previously. If you have any loan right now, all right, they will check out their history, your history, they will check out your income, your cash flow and all right, and then only they will be able to formulate, or you can say to estimate it, that whether they should give you the credit or not. Okay, but when we talk about the NBFC, then basically we are already talking about the undeserved market segments. It means that these are those people who generally do not, you can say, entertained by the normal banks. All right. So that's why they are being identified and served by the NBFCs. Thereafter, we have the innovative credit scoring. They often use alternative data and technology driven assessment tools to evaluate the creditworthiness of potential borrowers. This could include using algorithms that analyze payment history for utilities, rent, and even social media behavior. All right, like there are two type of things you can say for market understanding. Okay, first is product potential. Second one is customer base. Okay, these are the two important terms, or you can say tools of the market understanding. All right, so basically if we talk about this, first we design the product. Okay, means our services, our loan facilities, our time period and all. This is what? This is the product. First we design the product. All right, after designing the product, what we have the customer base. Okay, like how many people will be willingly using this product which we have designed, and this number of people will be known as the customer base. All right, so here you could also see this, that the NBFCs often use the alternative data and technology driven assessment tools to evaluate the credit worthiness of the potential borrowers by analyzing the potential of their product, or you can say the service. This could include using algorithms like checking out the payment history for getting the idea like how much they are spending, whether they are low class, whether they are medium class or middle class also, whether they are high class. All right, so you can say on their behavior, even on social media, is useful for evaluating that which class the customer base belongs. Okay, so students, basically in this lecture we have taken, and you can see the introduction, and you can say some of the topics of the credit intermediation. In the next lecture we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture, and what we say thank you.